What's going on, guys? Crypto Renegade here. In today's video, I'm going to be talking about a new project called Anchor Protocol. Decentralized finance, also known as DeFi, has exploded over the past few years with popular applications including collateralized lending by Compound and decentralized exchanges such as Uniswap. Anchor is set to be added to that list with its simple and convenient saving products, much like a CD or legacy savings account at your local bank, but powered by crypto and with rates of 20% annual percentages returns.
His revenue stream must be off the books, maybe even illegal.
Okay, cancel the deal.
But before I jump into the content, I just updated my new free ebook on the 7 best ways to secure your crypto, updated for 2021. It's 100% free. If you want, check it out in the description. It'll also be pinned in the comments. All right, let's get started. Anchor is a savings protocol on the Terra blockchain, offering savings products for Terra stablecoins with the aim to deliver a fixed rate of 20% annual return on each deposit. This is a huge improvement compared to traditional savings accounts. The Anchor rate is powered by a diversified stream of staking rewards for major proof-of-stake blockchains and therefore can be expected to be much more stable than money market interest rates. This basically means that the system works with a decentralized set of accounts that rewards savers more easily since they are more in number and everyone has the power to reward or be rewarded. This kind of accounts collaboration makes it more stable than the normal one where major banks give an advantage to the rich.
What are your superpowers again?
I'm rich.
The protocol is decentralized, meaning that you don't need to open an account, provide documentation, or ID verification. Simply connect up a Terra wallet to deposit your funds, and there you go. There are 3 parts to Anchor savers, which is much more than depositing. There are borrowers who take out loans and ANC shareholders who participated in governance and earn dividends. Those who are borrowers have to put down collateral to take a loan, which is then used to pay the interest rates of depositors. They also use a mechanism called the utilization ratio, which helps, for example, if there are more savers than borrowers. When the utilization ratio is high and there are more borrowers than savers, the borrowing rate increases, or if the utilization ratio is low, there are more savers than borrowers. The borrowing rate falls to incentivize more lending and collateral to pay savers. Anchor Protocol has its own governance token, or Anchor token, with ticker symbol ANC. The ANC token can be used to create new governance pools, which can be voted on by users and have staked ANC. Anchor Protocol, or ANC tokens, have to be bought with exchanges such as KuCoin and OKX or Uniswap, but they can also be used and buy and sell within the protocol. This also allows you to easily convert from UST, which is a Terra blockchain dollar, to ANC or vice versa. The Terra blockchain was created by a Korean blockchain firm, Terraform Labs. The Terra blockchain was created using the Cosmos software development kit and uses Tendermint, proof-of-stake consensus mechanisms. A proof-of-stake consensus algorithm is a set of rules governing a blockchain network and the creation of its native coin. That is, it has the same objective as proof-of-work algorithm in the sense that it is an instrument to achieve consensus. Essentially, transactions on the Terra blockchain take seconds to settle, plus the cost of transaction fees when interacting with smart contracts is a lot lower than using the likes of, say, the Ethereum network today. Their native token is the Terra Luna coin, which is the linchpin of the entire Terra network. Burning Luna coins helps to stabilize the Terra stablecoin ecosystem and incentivize usage. That basically means that since Luna token is crucial for the Terra blockchain, sometimes developers send a large amount of this token to a wallet to where no one has access. These tokens are basically lost, therefore increasing the scarcity for the token and affecting the blockchain speed for good. So how does Anchor protocol work with Solana? What is the connection between the Anchor protocol and the Cosmos network? And should we expect a little more? We're gonna try and answer that in this video. But first, don't forget to like, subscribe, and turn on that notification bell so you don't lose another video with the latest news about the latest Solana projects and coming soon Cosmos projects. Now let's talk a bit about Anchor savings on the Terra market. A core building block of the Anchor savings protocol is the Terra money market. This is a WebAssembly smart contract on the Terra blockchain that facilitates depositing and borrowing of Terra stablecoins. The money market is defined by a pool of Terra deposits that earn interest from borrowers. This basically means that borrowers use other digital assets as collateral to borrow from the pool.
Oh my God! I'm sorry, I thought this was the baby's room. I'm really sorry.
The interest rate is based on borrowing demand and supply. Borrowing from the Terra money market is as straightforward as locking up collateral in exchange for a loan. Anchor defines a loan to value ratio for each type of collateral, which indicates the fraction of the collateral's value that can be borrowed. Now, there are many products that you can stake and save, each with its own risk to reward profile, and each with a rate that fluctuates over time. What is the interest rate for the Main Street investor with all these options? Enter Anchor. This company aims to answer that question by using block rewards across blockchains. With Anchor, the return that depositors can expect is a function of the borrower's on-chain income. So basically, Anchor is like a middleman between the two, and no matter the assets used, since blockchains have different tokens. For this reason, the Anchor rate has the potential to be more stable than any individual yield or any fixed fee. Anchor implements a liquidation protocol designed to guarantee all of the depositors that the deposits are safe as the debts against them remain over collateralized. The function of the Anchor liquidation protocol is to maintain deposit safety by paying off debts that are at risk of violating collateral requirements. The protocol pays back at-risk loans using liquidation contracts, which undertakes the task of paying back debt in exchange for collateral plus a fee. The liquidation fee contracts also earn a passive premium charged to the borrower that are calibrated to ensure full coverage of outstanding loans.
Guy from corporate's here. Don't look. He wants to talk to you. I think it's about all those loans you've been approving.
Ooh.
Okay, so what this means is that these guys have created like a, well, kind of like a huge account full of money. Now you know how banks work, right? That they take the money you deposit and give out a loan to someone else. Yep, that's how banks work. Now, here's the principle that's basically the same, except that the money here is mainly used to keep both satisfied depositors who are saving money and borrowers who want to pay the loan. Depositors get their reward for keeping their money safe here in exchange for the amount that's loaned out. This account keeps everyone at bay even when a borrower doesn't have the funds to pay the loan. The account comes into play to do it for them and keeps the guarantee that the borrower gave at the beginning. The structure and incentives built into liquidation contracts enable them to provide higher robustness and solvency guarantees. Compared to a traditional banking system, banks rely on equal financial liquidations, which can result in a lack of cash at times of high demand. This can lead to a huge losses for borrowers. However, liquidation contracts are, on the contrary, fully collateralized and give you a longer withdrawal period to provide stability in the face of hard times. You can easily see the benefits here compared to an actual bank.
Don't trust big banks or small banks. Banks are Ponzi schemes run by morons.
Anchor is now joining forces with Cosmos and Solana. Anchor plans to acquire staking positions in POS blockchains that offer interest rates between 7 to 9% per annum per the release. The product will debut on both Cosmos and Solana and Terra blockchains. The creator also intends to scale the project to other POS ecosystems in the future. This new token represents a future claim to yield. So for example, if a Cosmos investor deposited 100 Atom tokens onto a staking platform advertising 5% annual yield, they would get back their initial deposit. If they traded that token in at the end of the year, they would get back 105 Atom. Pretty elegant for investors, isn't it? Lastly, let's see where this project is headed and the tokenomics. Now, Anchor Protocol, or ANC, currently stands at a price of around $2 as of shooting this video, with a circulating supply of 86 million tokens and a market cap of 173 million. You can buy ANC on exchanges like OKX, KuCoin, Gate.io, and several other DEXs. And with all that being said, that was it for today's video, guys. I hope you enjoyed it. Let me know your opinions of this project in the comments, and don't forget to like, share, and subscribe, and I will see you guys in the next video. Crypto Renegade out.